Congratulations, you made it to lab 3. This video is going to cover employee loans. So you've got questions, we've got answers, let's go! Employee loans refers to an employer providing their employee with a loan. The question becomes, is there a benefit made to the employee by virtue of their employment? There's a provision in the Income Tax Act that covers this. Let's take a look. So grab your Income Tax Act and maybe first of all turn to the detailed table of sections. Remember where to go? Go to the first visual indicator and turn to the first page of that indicator. And you should see the detailed table of sections. If we look at Division B, Subdivision A, we deal with income or loss from an office or employment. And if we look at where Section 6 begins, we are looking at inclusions or amounts to be included into income as per Subdivision A. If you go to Section 6, Subsection 9, you'll see it says amount in respect of interest on employee debt or employee loans. Let's go to Section 6, Subsection 9. Once you've turned to that page, you should see Subsection 9, which talks about amount in respect of interest on employee debt. It says where an amount in respect of a loan or debt is deemed by subsection 80.4(1) to be a benefit received in a taxation year by an individual, the amount of the benefit shall be included in computing the income of the individual for the year as income from office or employment. Let's break that down. Where an amount in respect of a loan or debt is deemed by subsection 80.4(1) to be a benefit received in a taxation year by an individual. So this means that the amount has to be deemed by another provision in the Tax Act, 80.4 subsection 1, and that provision must deem it to be a benefit received in the year by an individual. The individual must receive the benefit. It goes on to say that the amount of the benefit shall be included. So if there is a benefit, it shall be included in computing income of the individual for the year as income from an office or employment. So it gets to be quite specific. It says if there is a benefit, that benefit will be included and specifically included in Subdivision A, office or employment income. So let's go to 80.4 subsection 1, that subsection there that I've highlighted, and see if we can find that provision and see what it says. 80.4 subsection 1 deals specifically with loans to employees. It talks about deemed interest. Where a person or partnership receives a loan or otherwise incurs a debt because of or as a consequence of a previous, the current, or an intended office or employment of an individual, or because of the services performed or to be performed by a corporation carrying on a personal services business, the individual or corporation, and it goes on to say as the case. So before I continue, let's quickly break down what we've read so far. It says where a person or partnership receives a loan, okay, or otherwise incurs a debt. So that's the kind of transaction we're talking about. We're talking about an employee loan. So why has this loan or debt been incurred? Well, because of or as a consequence of a previous, the current, or an intended office or employment of an individual. And what that is trying to say is if an employee were to receive a loan because of their prior job, their current job, or a job they're about to take on. In other words, the Tax Act is trying to be comprehensive. It's trying to cover different scenarios. If we keep reading, it goes on to say then that individual shall be deemed to have received a benefit in a taxation year equal to the amount, if any, by which the total of. Okay, so they'll be deemed to have received a benefit, and if any, so it really depends on what the calculation is going to result in. Paragraph A, it says all interest on all such loans and debts computed at the prescribed, there's the word prescribed, rate on each such loan and debt for the period in the year during which it was outstanding. And then I'd like us to focus on this, where it says exceeds the total of. And we're going to focus on paragraph C, the amount of interest for the year paid on all such loans and debts not later than 30 days after the end of the year. So really what we are going to be looking at is to calculate this benefit. We're going to be looking at paragraph A, the interest on all such loans and debts computed at something called the prescribed rate. And by how much does that exceed paragraph C, the amount of interest paid on all such loan and debts not later than 30 days after the end of the year. Okay, so the amount of interest paid not after 30 days after the end of the year. We see the word prescribed, which leads me to think that we're going to have to figure out what the prescribed rate of interest is. So if we look beneath the provision, we can see related provisions, and we can see the regulations. And the regulations point us to 4301, Regulation 4301, paragraph C. Why don't we quickly go there? Here we are, Regulation 4301, prescribed rate of interest. And we actually get a nice little table in the printed version of the Income Tax Act by each paragraph in 4301. We're interested in 4301C. And you can see for a given year along the left, and we can keep going here. So for a given year, we have a prescribed rate. So for 2018, in the first quarter, the prescribed rate was 1%. In the second, third, and fourth quarters, it was 2%. In 2019, it was 2% for the entire year. In 2020, it was 2% for the first half of the year. Then in the third quarter on, it seems to be 1%. Now, sometimes in a question given to you on an exam or in a lab or in your textbook, you will just be told what the prescribed rate is. In other words, you'll be given a fictional scenario where you don't have to look up the prescribed rate in the Income Tax Act. And if that's the case, if a question kind of tells you use this number as the prescribed rate, well, use the number that's provided as the prescribed rate of interest. Otherwise, if you aren't told what the prescribed rate is, then you have to go to the Income Tax Act and look it up. I'm hoping you're all following with me so far. According to ITA 6, subsection 9, an employee must include any benefit from an employee loan into their income. The benefit is assessed or calculated according to ITA 80.4, subsection 1. And what it told us to do there was take paragraph A, which is the prescribed rate of interest on the loan, and subtract paragraph C, which is how much was paid back within 30 days of the end of the year on the loan. Where do we get the prescribed rates from? The prescribed rates are from Regulation 4301, paragraph C. And if we provide you with a question with a different prescribed rate, use that instead. Now, what if the loan that is taken from the employer by the employee, what if the proceeds of that loan are used to earn income? What do we do then? There's a few provisions I want us to look at with respect to interest deductions, because if you are using a loan to try to earn business income or property income, the taxpayer might have a few extra deductions available to them. So let's quickly take a look at those. If we take a moment and come back to the detailed table of sections, if we know we are looking for deductions related to business or property income, we want to go to subdivision B. Subdivision B deals with the income or loss from a business or property. We know we have the basic rules to begin with. Then we have inclusions, but we are looking for deductions. And deductions begin with section 18. And if you've been following along in the textbook and in your lecture, you know that section 18 starts off with limitations. In other words, it starts off talking about what cannot be deducted. ITA 20 starts talking about deductions permitted in computing income for business or property. And we are specifically interested in paragraph C, which relates to interest. Let us first of all go to section 20, subsection 1, to ensure we get the appropriate context. Please navigate to that page. Section 20, subsection 1 discusses deductions permitted in computing income from a business or property. I'll start reading from here. In computing a taxpayer's income from a taxation year from a business or property, there may be deducted such of the following amounts as are wholly applicable to that source, or such part of the following amounts as may reasonably be regarded as applicable thereto. In other words, the following paragraphs will be deductible to the extent that it says it is. One of those following paragraphs is paragraph C, an amount paid in the year or payable pursuant to a legal obligation to pay interest on borrowed money used for the purpose of earning income from a business or property. And I think that's going to be good enough for us for now. We know we can deduct interest if money is borrowed for the purpose of earning income from a business or property. That's important to remember. If a taxpayer borrows money, even if it's from their employer, if they are using it to earn income from a business or property, that interest is deductible. And there's one other provision that we would like you to study. Let's take a look at that. So if we go back to the Income Tax Act, where it says interest, if we go to related provisions, there's a lot of related provisions here, but the specific one that I want to look at today is 80.5, deemed interest, employee deductions. So if I could ask you all to navigate to section 80.5. And if we get to 80.5, it talks about deemed interest. And this is somewhat interesting and somewhat confusing. Where a benefit is deemed by 80.4. So there's 80.4 again. And remember, 80.4 was the provision where we calculated the interest benefit. So if there is an interest benefit according to 80.4 to have been received in a taxation year by an individual or corporation, and that would be the case in our question that we're working on today, the amount of the benefit shall, for the purposes of paragraph 81JI and paragraph 21C, which is where we are coming from, it is deemed to be interest paid in and payable in respect of the year by the debtor. So it's deemed to be interest paid. In other words, if a taxpayer has borrowed money from their employer and they are using it to earn income from a business or property, that taxpayer has to follow the rules in ITA 80.4. They have to calculate a benefit. Well, the amount of that benefit, according to 80.5, is deemed to be interest paid. So it's almost like they get to deduct that benefit and net out the entire amount. I'll show you what I mean when we get to the question. Lab 3, question 1. Vineet received 2 loans from his employer on January 1st of this year. My employer doesn't even pay me for all of the work that I actually do. They're never going to give me a loan. So this is a made-up fictitious question, but still worth going through. Let's take a look at each loan. A $5,000 loan to purchase a deluxe bouncy castle for his backyard, bearing interest at 6%, and a $100,000 loan to purchase a boat bearing interest at 4%. So I think we can highlight the amount of the loan or the proceeds of the loan and the interest that they are bearing. That's important. Vineet plans on renting the castle out for local birthday parties 60% of the time. He will allow his daughters to use the castle for their own enjoyment during the remainder of the time. Vineet earns $1,000 in revenue from renting out the bouncy castle during the year. Assume the prescribed rates for this year were. Now, this is important, everyone. I've shown you already where the actual prescribed rates are, but you'll notice in this question, you're not given an actual year. We don't know what year this is taking place in. If we tell you that the prescribed rate for the first quarter is 7%, second quarter is 9%, third quarter is 8%, and fourth quarter is 9%, please use those rates. The next thing that you need to be aware of is Vineet paid the interest on these loans on December 31st. You are asked to do a few things. 1. Compute the total employee loan benefit and indicate which Section 3 paragraph, subdivision, and provision the amount would be included under. In other words, you've got to do the math and calculate what the total benefit or the total inclusion would be. Then you have to go a step further. You have to indicate where would that go in Section 3 and what subdivision does it belong to. Then you have to go yet further still and indicate the provision that states the amount has to be included in the first place. After that, you are to determine whether or not any deductions are allowed and indicate which Section 3 paragraph, subdivision, and provision the amount would be deducted under. Finally, you need to demonstrate how all of these amounts would appear in paragraph 3A, okay, using proper Section 3 formatting. Let's get to it. I've brought up the legislation and put it on the right side of the screen. And as a reminder, we're going to start with requirement 1. So we have to calculate the total employee benefit. And then we'll indicate which Section 3 paragraph, subdivision, and provision that benefit would be included under. So taking a look once again at ITA 6 subsection 9, we are to include a benefit that is deemed by subsection 80.4 subsection 1. And recall 80.4 subsection 1, what we are going to do is we are going to take paragraph A and take all interest on all such loans and debts computed at the prescribed rate, and from that we will be subtracting paragraph C, the amount of interest for the year paid on all such loans and debts not later than 30 days after the end of the year. So the section 6 subsection 9 benefit as calculated under 80.4 subsection 1 would be, first we calculate the interest for both loans. We can take 80.4 subsection 1 paragraph A and we could take the castle loan, which was $5,000 at 7% prescribed rate for quarter 1, and then 9% for quarter 2, 8% for the third quarter, and 9% for the fourth quarter, for a total 80.4 subsection 1 paragraph A subtotal of $413. If we then take a look at the boat loan, the proceeds of the boat loan was $100,000, but it was made in the same year, so the prescribed rates would be the same, and the subtotal there would be $82.50. If we add up the amount for each loan, we get $8,663. Now we need to deal with C, which is actually subtracting the interest actually paid. So if we subtract the interest that's actually paid, it was 6% paid on the castle loan of $5,000 and 4% on the boat loan of $100,000. That would total $4,300 paid. If we subtract that from the imputed interest of $8,663, we arrive with $4,363. That amount would be included under 3A subdivision A. The provision that required that to be included was 6 subsection 9. Let's turn our attention to requirement 2. Determine whether or not any deductions are allowed and indicate which section 3 paragraph, subdivision, and provision the amount would be deducted under. Recall ITA 20 subsection 1 paragraph C with respect to interest allows the deduction of an amount paid in the year for borrowed money used for the purpose of earning income from a business or property. This relates to the question that we are working on as follows. We have to deduct an amount with respect to 20 subsection 1 paragraph C. Recall that for the castle loan, actual interest paid was $300, but the bouncy castle was only used for business purposes 60% of the time. So we can deduct 60% of that $300, or in other words, $180. I'd also like you to remember that I did mention a specific related provision, 80.5 deemed interest, which we can use in some cases. We can use in a case like this. Let's go to 80.5 again. 80.5 allows the taxpayer to deduct interest where a benefit is deemed by 80.4. The taxpayer can deduct the amount of the benefit shall, for the purposes of paragraph 20, subsection 1, paragraph C, is deemed to be interest paid. Well, let's see how that would work in what we're working on. If we go up, we can see that from the castle, we calculated the imputed interest, or the interest on the prescribed rates, to be $413. And the actual interest paid on the bouncy castle was $300, meaning the benefit on the bouncy castle was $113. And 60% of that was used to earn business or property income, which is the requirement for paragraph 21C. So we can take this $113, the net benefit to the employee of that loan, and we can deduct 60% of it. So taking 60% of the $113 calculated right here gives us $68. For a deduction under subdivision B of $248. So now let's go to requirement 3 and demonstrate how all of these amounts would appear in paragraph 3A. You would have 3A, and then you would indicate the subdivision. You would have employee loan benefit of $43.63. And again, if you had their employment income, you would list that as well under subdivision A. Next, you can move to subdivision B, and we have business income from the bouncy castle of $753. Now, how did we get $753? Well, recall that we have business revenue of $1,000 for renting the bouncy castle, and then we had the deduction of $248. That results in $753. Okay, now where's that $248 coming from? That $248 comes from our result in the previous requirement, required 2. The total deduction was $248. So if we take the revenue and subtract the expenses, our income from the bouncy castle business is $753. That would go under subdivision B, business income, $753. If you were to subtotal 3A, you would get $5,115. So there was a lot there. I hope you managed to follow it all. I encourage you to try the question yourself a couple of times and come back and watch this video as and when you need it. Happy studying, and until next time, thanks for watching.